Hi, I'm Doug Carroll. Welcome to Capital Markets Roadmap. What we intend to do today is give you a brief but broad introduction to the capital markets, who are the primary participants, issuers, investors, intermediaries, what they trade there, and both the applications to which market participants make use of the instruments, as well as give you a sense of the role that the capital markets play in the operation of the economic system as well as the financial system. So without further ado, why don't we begin our discussion of capital markets. So what we want to get first is a fair grounding to make the further discussion more enlightening and understandable. So we want to talk about what capital markets are, who are the primary players in those capital markets, and how they use what's traded there to accomplish whatever goals they're trying to accomplish. So first off, what are the capital markets? Well, we'll look at this in quite extensive detail in just a few minutes. But in simple terms, capital markets are the markets where financial instruments are traded. And we could talk about sort of four broad segments of the capital markets, as you can see on the exhibit, those being the securities markets, derivatives markets, foreign currency markets or currency markets. And most people don't immediately associate these with the others, but insurance markets are also part of the capital markets as well. And we'll discuss a wide range of the intermediaries, both the investors, institutions and individuals, the issuers, those that issue the securities and other financial instruments, as well as the parties that help that process along, the intermediaries that get the securities from the issuers to the investors and so forth. And finally, what are the important functions performed by the capital markets? We'll touch on those briefly here, but after we describe the markets in a little bit of detail, we'll come back and revisit these to make sure you have a solid grasp of exactly what role the markets play in the functioning of the economic system as well as the financial system. So in brief, those are channeling wealth into real investment. In other words, how do we move wealth, money, from where it's accumulated, and how do we get that into real investment? And of course, by real investment, I don't mean buying stocks and bonds. I'm talking about building factories, buying equipment, training workers, developing new products. That's typically what is meant by real investment. So activities that either expand the economy's ability to produce goods and services, or actions that allow the economy to produce the same amount of goods and services with fewer resource inputs. Secondly, pricing. Because one of the important functions of markets is to give off signals where returns are high to attract more capital to those activities. Or for that matter, where returns are low or possibly negative, drive capital out of those low return uses and hopefully into more productive, more high return uses. Liquidity, the ability to turn investments into cash so we can spend that for consumption or other related purposes. And finally, managing risk. And as we'll see, that may be one of the most important functions of all of the elements of the capital markets, is to allow risk to be optimized, if you will. Because oftentimes when people hear risk management, they think risk reduction. And actually, risk management is more nuanced than that. Risk management means, in effect, right-sizing risk, adjusting the risk of your asset or liability portfolios to a level that's consistent with your degree of risk tolerance or risk aversion. So let's look at all of those issues in a bit more detail. So the broad segments of the capital markets I identified already, securities, derivatives, currencies, and insurance. But now let's look at those in context, as well as talk about the primary subsectors of each of those market segments, and a little bit about what investors and issuers use these markets for. In fact, these same categories, let's look at in the context of an exhibit that tries to integrate some of these ideas. So here you see the four broad segments of the capital markets that I've already identified. So again, those are the securities markets, the derivatives markets, the currency markets, and the insurance markets. And while they all have numerous interconnections, the primary functions of the four are a little bit diverse, although they clearly have something in common. So let's look at first the primary subsectors of each market. So for the securities markets, there's two broad subsectors, the equity securities and debt securities markets. Now we'll look at both of those in more detail in brief in a few minutes, and then extensive detail later on in the program. But equity securities are securities that represent ownership interests issued only by private organizations that can sell ownership interests, and debt securities, which are issued by both private entities like partnerships and corporations, but also by public entities, governments, government agencies, local and regional authorities and governments. And you might recall from the last slide, I had a third entry under the heading of securities markets, and those are hybrid securities. We probably won't talk about those much given the brevity of the treatment we're able to give the subjects today. But hybrid securities would be those that combine elements of the other two, that is, of debt and equities. So for instance, convertible bonds, debt securities convertible into equities. Or structured notes or structured deposits. These are debt instruments that under normal circumstances pay interest to the holder of fixed or floating rates, issues we'll talk about later. But the structured notes or structured deposits actually are debt securities, but the rate of return is potentially tied to the performance of some equity, like the S&P 500 or an individual equity security. Next up, the derivative markets. Now, we'll talk about derivative markets in more detail and from a different perspective later on. But most of the time when people think of derivatives, they recognize three broad categories, futures and forwards being one. You might say, wait a minute, those are two different things. As we'll see later, they're basically the same thing with some technical differences, but from an economic substance perspective, they're the same. Options, puts and calls as well as exotics, and swaps. And there's a wide variety of different sorts of swaps: interest rate, commodity, currency, equity, and credit default, all of which we'll touch on very briefly later. And we'll try to give you maybe a more insightful way of looking at them other than simply identifying the segments as we're doing now. Then the currency markets, and most of the time when people think of currency markets, they're thinking of the national currencies, the pound, the euro, the yen, the dollar. And really, when we're talking about currency markets, we're always talking about currency pairs, because currencies are always going to have their value expressed in terms, or at least usually have their value expressed in terms of some other currency. How many yen per dollar? How many Aussie dollars per Kiwis, that is New Zealand dollars? How many Canadian dollars per French franc? So we'll look at some of the details later. And you might note I have a couple of other alternatives up there under the national currencies. SODRs, as they're sometimes called, that's the SDRs mentioned here. Those are actually claims or interests issued by the International Monetary Fund. It stands for Special Drawing Rights. And some people have proposed it as an alternative currency to say, the dollar. And then gold is mentioned up there as well, of course, because while gold is clearly a commodity, it has had a monetary function for many millennia, as a matter of fact. And most major central banks have significant holdings of gold. So while Ben Bernanke, the current short-term chairman of the Federal Reserve in the United States, in response to senatorial inquiries was saying, well, no, gold isn't really money, clearly central banks treat it as a monetary asset. And then finally, the insurance markets. And there's a wide variety of insurance lines. I don't mean to go into them in detail here, but in general, we could break them down between commercial and individual or family or private insurance. And you might say, well, what's insurance doing up here? This isn't really part of a capital market function. Well, that's actually likely one of the big growth areas, is the increasing securitization of insurance risks. As an example, sometimes you'll see what people refer to as cat bonds, where CAT is short for catastrophe. In other words, insurance companies will issue these bonds and they don't have a set payout. It depends on the insurance company's underwriting performance. That is, how many losses claims are filed with the insurance company. So for instance, in a high-risk area like a place where earthquakes are fairly common, or hurricanes are fairly common. You'll see insurers issue these catastrophe bonds, and if their underwriting losses, that is the claims file that they have to pay out, fall below a certain level, the bondholders get a higher payout. But if the insurance losses, that is the losses on claims that the insurance companies have to pay out as a result of claims filed due to, again, some sort of catastrophe like a hurricane or an earthquake, well, if their underwriting losses exceed some specified level, the bondholders get a smaller return, a lower coupon in effect. So that's an example of a securitization of those insurance risks. Now, looking at the functions of those four market sectors, you might remember the functions we'd mentioned earlier. Well, one of those was channeling wealth into real investment. We'll look at that in more detail in just a few minutes, but that's really what the primary purpose of the securities markets are. The derivative markets, on the other hand, don't really directly cause or facilitate the flow of wealth from where it's accumulated to where it's going to be put to use in the real investment we talked about before, although they support that in some way. But derivatives' primary function is to allow us to share risks more optimally. In other words, those who are risk averse can reduce the risk of their asset or liability holdings by hedging. On the other hand, those who are willing to take on more risk and the desire for generating higher returns on capital, well, they can create exposures, that is, positions in the market, by taking a derivative position as opposed to doing it through securities or other sorts of instruments. Currency markets, on the other hand, primarily exist to allow us to change the form in which we're holding capital from one currency to another currency. And clearly that has many obvious applications. Facilitate cross-border flow of goods and services. Facilitate cross-border investment, whether it's portfolio investment or what's called FDI, foreign direct investment. In other words, rather than buying securities denominated in other currency, actually buy real assets, property, equipment, factories for that matter. And insurance markets actually are quite akin to the derivative markets because, again, the primary purpose of the insurance markets, like derivatives, is to allow us to share risks more optimally.